All right, so welcome to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom, and today we are going to be doing, or this evening, we are going to be doing the Homebuyer workshop. I am going to go ahead and put it to a workshop picture, and we're going to wait just about a minute, minute and a half to let people that want to be here log in, join, and get on YouTube. So don't go anywhere. I'm coming back in like 60 seconds, and we'll get everything started. Tonight we are doing a home buyer workshop. So hopefully you guys are here, you're ready to learn, you've got questions for me. I want to invite you all to put your questions into the chat. I will read those questions and I will answer them for you. I do want to let you all know that you can't actually put a question in the chat unless you are subscribed to the channel. So if you have not subscribed to Mortgage Mom Radio, make sure that you do so. That way you will be able to type in the questions and ask them. This is going to be kind of a longer workshop because we are going to take you from start to finish through the process. I do want to be able to try to hit on everything. So I did actually pre-record the slides so that you guys can listen to a whole slide and get what's happening. But during those slides, I do want you guys to put your questions into the feed. I'm going to come back live after every slide that I've prepared for you, and I'm going to answer your questions, or I'll get more in detail if you have questions about, what I said. So please don't hesitate to do that. I can see that the Barkley group has jumped on, so thank you so much for being here. Really hope that all of you guys do get a lot from today's workshop. So we are going to jump right into the first slide. And again, please put those questions in the feed as we go. I am more than happy to answer all of them. We'll stay as long as we need, but I do want to try to make sure that I hit everything. So instead of just completely rambling like I usually would, and it's 3 hours later and you guys had got everything, but it was 3 hours long, I'm trying to shorten that up. So I did go ahead and purposely made very direct and intact information. And then I'm going to answer the questions after every single slide. So please make sure that you guys put those questions in there. I can see another person jumped on. I can't read the name. I'm not. Old eyes. But it does say, thank you for the workshop. You look beautiful. And thank you. That makes it all worthwhile. Doing this at night makes me feel so much better now. So thank you. All right, go ahead, Mikey. Let's all jump in. If you don't have 20% down payment, that it is calculating it accurately. So it's giving you conventional MI, FHA, MIP, the VA funding fee that gets financed in if you are not considered a disabled veteran. And the USDA also has a financing fee as well. So this is a really, really great app. You can also apply for your mortgage. You can contact us. You can call us. You can watch YouTube. So it's a really cool app. And what you're going to do once you get that text message, you will get a text message back with the link. You're going to click on it, and then you are just going to save it to your home screen. So it is now on your home screen as the Mortgage Mom Radio app, and you've got all of these tools at your disposal. Okay, so welcome back. I'm so sorry you guys couldn't hear the beginning of the slide. So what I was trying to say to you is that as you are going through those open houses and you are wanting to know what those monthly payments would be, or you are going through Zillow or Redfin in your window shopping, those calculators on those sites are not giving you that mortgage insurance, or if you're a vet, it's not calculating the financed upfront funding fee that goes into the loan. So for those different types of loans, it will calculate everything for you, including the taxes and the insurance. If there's something that you don't know what to put into that application, so you're not sure what to enter for insurance or what to enter for taxes or what interest rate you should be putting in there, it's as simple as using that phone app. It says contact us, email Debbie, and you can actually send me a message with the information. What do I put in here? And I'm going to give you that information to go ahead and add to that calculator. I can see that Heidi says hello all. And then it looks like Laura Perez, she's here. She said she couldn't hear anything either. And Allie says, I missed a lot of what was said in the beginning. There was no audio. So I do apologize. Basically what I'm saying is that I am going to take you guys from start to finish through the workshop. And I do want to make sure that we stay on time. I don't want to be here for 3 hours rambling to you. You'll get all the information, but nobody wants to be on a YouTube for 3 hours. So I do have my slides and we're going to run those slides, but I do also want you guys to be putting in your questions. I'm going to come back after every slide because I want to make sure I hit all of the important details, and then I'm going to answer all of the questions on each slide as we go. So make sure you guys keep using that chat. I really do appreciate it. And thank you for letting me know that you couldn't hear us. We did fix it, and we should be good to go now. So we did the phone app. And if you have any questions about that, feel free to throw that into the feed. But let's go ahead and we are going to move on to the next part, which is, let's see what we're doing next. Buzzwords. So we're going to hit some buzzwords right now. What in the heck are they talking about? Just like I've got up on the screen. There are so many words that are so important to understand in the transaction, and it can absolutely feel like somebody is speaking a different language to you when they start asking you questions like contingencies and escrow and your payment. So I do want to take you through a couple of those really important words, but I want to remind everybody that just for time sensitivity and to not keep you here in this workshop for the next 3 hours, I'm not going to hit them all or give you the definitions of all of them, but they will be in this workshop that will sit here on YouTube. So you can go back, you can pause the page, you can read all of the definitions on these PowerPoint slides. And if you have questions, you can send me an email, and you can actually email me right through that phone app that you guys just put on your phone. So let's go ahead and scroll, Mikey, to the next page. Okay, so real estate buzzwords. Here we go. So we all know that we have to order an appraisal. A lot of people get very confused that an appraisal and a physical inspection are one and the same thing, and they are not. An appraisal is being ordered by your lender from a third party, neutral third party. We don't even get to select the appraiser that is being assigned to your property. We have to order through a system, and then it gets randomly assigned out. So you cannot look for your own appraiser to try to save on cost. You cannot order your own appraisal. The appraisal does have to be ordered by your lender. The appraiser is evaluating the value of the property. The lender, the bank, wants to know that they're not giving you a loan for more than what the home is worth. So it is very important to understand that this is not somebody that is going out there to make sure that the property is in perfect condition. Now, your physical inspection, you as the buyer get to choose the contractor or the home inspector. A home inspector is not required to carry a license. It's good if they do. But you are choosing the person that you want to go out and do the inspection to actually look over the home. The roof, is it in good shape? Are all the appliances working? Does it seem like there's any plumbing leaks anywhere? Is there mold somewhere up in an attic? So things that are very important that you need to know before you seal the deal on this property is your physical inspection. Now, an appraiser will actually look for blatant items. So if there are stains on the ceiling, then they're going to say in their appraisal report, it appears that there could be an active leak, or maybe there was a prior leak, but would suggest getting a roof certification. So the appraiser will actually bring up things that would be important for the lender to know that could be an issue with the property, but they are not there to do an actual inspection. Your escrow, I do want to get down to that for a minute. You'll see the word escrow, and that is where a lot of people get very confused, because you have your escrow, which is an escrow company if you are in an escrow state. Some states are not escrow states. Most of the West Coast is. Nevada is, California is, Arizona is, Texas is an escrow state. But some are attorney states. So for example, Illinois is an attorney state, so they do not use an escrow company. An escrow company is a neutral third party that is taking direction from all parties within the transaction. So your buyer, your seller, the real estate agents, they are that neutral third party in between all people, and they are taking instruction, and then they are making sure that everything is done in the right way according to the contract. So in some states, an attorney would be making sure of those that's happening, as buyer and seller would each have their own attorney. There's also title states where a title company does all of it. A title company issues title insurance, and that is even in an escrow or an attorney state. But a title company can also act as an escrow company, as being that neutral third party for a transaction. So it depends on the state that you're in, whether or not you're going to have an escrow company. But that can get very confusing if you are talking right below that, escrows or impounds. So you can get kind of confused about what people are talking about. So your escrows or your impounds are the part of the mortgage payment that are covering your property taxes and your homeowner's insurance. And in most mortgage statements, when you receive them in the mail after you've closed your loan, it will say principal and interest, escrows. And so just remember that escrows, and many loan officers will refer to them as impounds because you have an impound account. We're impounding your taxes and your insurance. But in most mortgage statements, it will actually be referred to as escrows. Your homeowners association will very many times be considered an HOA. So you're going to hear people talk in short terms. So it would be HOA, or your homeowner's insurance could be HOI. Your loan officer could be LO. The loan estimate. So you are going to receive a loan estimate, which I will talk about as we get a little bit further into the workshop. But that is an initial estimate of your loan terms. It's your loan officer's best guess, but they'll call that an LE. Your loan to value could be called an LTV. So you just want to get comfortable and familiar with all of these terms. Mortgage insurance can get very confusing because mortgage insurance is something that is paid separately away from your homeowner's insurance. So homeowner's insurance is your fire insurance. If you choose to get earthquake insurance, if you live in an area that's considered a flood zone, you'd have to get flood insurance. Mortgage insurance compensates the lender if you do not make a payment, if you go into foreclosure. So mortgage insurance is required on all mortgages that are not 20% down payment or more. And even with FHA, if you have a 20% down payment, but we're going FHA for one reason or another, which we will get into further into the workshop, why would we maybe select an FHA loan, even if you had that bigger down payment? You will still have that mortgage insurance. They call it a mortgage insurance premium with FHA, but most loans are considered PMI. So let's go ahead and move on to the next one, Mikey. And this next one is just property taxes, which you guys, again, can read on that. I'm sure most of you probably know what that is. Your real estate agent versus a realtor. So many people don't realize that there is a difference between just a real estate agent or having the title of realtor. Termite inspection, we're going to talk about that down the road just a little bit. Your title report, so this is the title company that is going to issue the title insurance, will give us what's called a prelim. So you could be like, what is a prelim? And somebody, I got your prelim in today, and that can get very confusing. So your prelim is a title report. It is pulling all of the information about the property, all of the liens that are tied to the property. So if the seller has a mortgage, maybe they have a home equity line behind that mortgage. Maybe they have some sort of a mechanics lien. Somebody issued a lien against the title of the home because they didn't pay a bill that was due. If they have an IRS lien, that IRS lien could be attached to a property. So the prelim, or the title report, is going to tell us what all of those liens are, and your lender is going to require that all of those liens have been satisfied. So you have a free and clear title prior to closing. And then your next word is just underwriter, which I think you guys mostly get, but you can read that. And again, reach out to me with any questions that you might have about any of the words on these couple of slides. Okay, so I can see that Laura actually asked some questions. She says, is there a way of getting rid of PMI? Is there a way of removing the PMI on a current home? So those are actually great questions, and it depends on the type of loan that you have. So if you have a conventional loan that is already in place and you have actually paid your mortgage balance down by 22%, so you need to have 22% equity or only owe 78% of what the property is worth. you can actually request from the lender to remove the mortgage insurance. Now, one thing to keep in mind with that is a lot of people think, oh, my property went up in value. We all have a ton of appreciation going on right now. If you own a home, your house has gone up in value for the most part. There's going to be a couple of pockets across the nation that maybe that isn't happening or they've actually seen some declines. But for the most part, the majority of homeowners have actually seen appreciation, even with interest rates being super high. So we didn't see a downgrade in property values. We actually saw them go up. So you can't just have your property value be worth more to remove that mortgage insurance. You actually have to pay that balance down from where its original sales price was, or the original appraisal, if it was a refinance, to that 78% mark where you have that 22% equity. Then at that point in time, yes, on a conventional loan, you can request to have that mortgage insurance removed, keeping the current loan that you have intact. However, on an FHA loan, mortgage insurance is actually for the life of the loan. There's very few instances on FHA where it could be removed, and that requires a pretty big down payment as well as a 15-year loan term, which the majority of people that are getting FHA loans trying to get in with the minimum 3.5% down would not be doing. So with an FHA loan, you would have to actually do a complete refinance to remove that mortgage insurance. And I can see Heather jumps on and Heather says hi. So thanks for joining, Heather. I love it. Laura, keep those questions coming. And I just want to remind everybody, this is interactive. So if you have questions like Laura does, please put those into the feed. At the end of every PowerPoint, I'm going to come back. You guys are going to see me and I'm going to read those questions and I'm going to answer them for you. So the more questions that we get, the more information that I deliver. So please keep them coming. I absolutely love it. So we are going to move on now. Let's see where I'm at. We did our buzzwords, and now we're going to jump into the benefits of homeownership. So here we go. Of homeownership. Why would you want to own a home? And there are going to be benefits, but then there's also going to be some downsides that we need to talk about as well. And that's going to be when we get to the next part of the workshop. So right now we're going to talk benefits of homeownership. So one of the things that you are going to get as a benefit would be building wealth. So as you've heard me talk about it multiple times, or you've heard friends or family talk about the appreciation and your home going up in value. And many people experienced a really bad point in time in 2007, 8, 9, where property values, even 2010, where property values massively declined. And you have to remember that the market is cyclical. So the property values are going to go up, they're going to come down, they're going to go up again, but they're going to go around in a circle. But they're always going to end up higher than they landed the last time. So at the last peak, the next peak is going to be higher than the peak before, and the next peak is going to be higher than the peak before. So real estate is a long-term investment. It is something that you want to think in your mind. You are buying something for the long haul. As long as that is the mindset that you have, then you don't have to worry during the dips and when things come down, because real estate will always go back up. In all of history, real estate has never not done its cycle. So you are going to be building wealth by being a homeowner. You will have tax savings. So you are going to be able to write off your interest that is paid on your loan, your property taxes that are paid on your loan. So you can see this is an old one. It's a 2020, but this is your 1098 that shows you what you paid in mortgage interest and property taxes. As of right now, during this current administration, mortgage insurance, so that PMI insurance that you pay if your property does not have that 20% of equity, that is also tax deductible, where you can write these things off, which will help you with a better return. You have security, so you don't have to worry that somebody is going to come to you and tell you that you need to move. Nobody's going to leave a note on your door that you've got a 30-day notice to quit. Nobody is going to tell you that they've decided to sell. This is your security. This is your home. Nobody can tell you that you have to leave unless you don't make your mortgage payment and you were to get foreclosed. But other than that, this is your security. Nobody is going to make you move when your kids are in a certain school district, etc. etc. You have the pride of ownership. So one thing about being you're an owner of a home and owning it rather than renting is that you get to do whatever you want. You get to replant your yard, you get to make it beautiful, and you are proud that that is your home. And it really does make a huge difference over being a tenant. You get to paint all of your walls and change all of your flooring and decorate it the way you want and hang up a picture or put an anchor in a wall where maybe you couldn't do that as being a tenant. So the pride of ownership is a very, very important piece of the benefit of home ownership. And then we're also talking about building good credit. So when you have a mortgage and it is on your credit report and you're making that payment and you're making that payment on time, month after month after month, you will see that your credit, if you've never had a mortgage before, you will see that your credit is actually, credit scores get a little bit higher because you have that mortgage on your credit report. Okay, so I did see some questions come in, which I absolutely love during that slide. So I do want to get to those. Michelle did ask, but that still will take a long time. And don't you still have to pay for another appraisal? So this is going back to, can you remove the PMI insurance from the current mortgage? So every lender, so it's not even the lender, it's the servicer. So there are servicing lenders. They're the ones that collect your mortgage payment every month, and they do have their specific requirements to remove mortgage insurance. However, if you have paid your balance down, so from where the original appraisal was, again, whether that was the purchase or a refinance, whatever the appraisal was during that transaction that they have that loan that they're servicing, and you have paid that balance down to where you have the 22% equity, they do not have to order a new appraisal. There are some lenders that will allow a new appraisal to be utilized to remove mortgage insurance, but they always, I'm going to say the majority of the time, I can't say every single one of them, but every servicer that I've ever worked with or dealt with has required not only the appraisal, but then all of a sudden you get a question of, have you done improvements and can you show us what you spent? So once again, they're looking to see that your home went up in value because money was spent for that property to be worth more. Again, money spent is reducing your loan to value. So an appraisal is not always required if you're literally just paying that balance down to that mark where that mortgage insurance can be removed. Okay, so the next one is, and it'll take a long time. It can. It depends on how much money that you put down on the home, how long that it does take to get to that point. Especially if you're making, just the minimum mortgage payment every month, it really, it can take time. It can definitely take time. You would be better off if your property went up in value significantly to just do a refinance and get a new appraisal with a whole brand new home loan and removing that mortgage insurance. That would be definitely faster if you were in that situation. Okay, so the next question comes from Rolando, it looks like. And again, my eyes aren't good. And for some reason, the names are in red, which is making it really hard to see. But it says, how can someone strategize best to get an assumable mortgage? Is it worth it? So assumables are fabulous, especially during times like today, where interest rates are higher than what they were previously. So if somebody has a mortgage that is an assumable mortgage, so that is allowed based on the paperwork when they took the loan, then you could walk in and assume that person's loan, which gives you the interest rate that they took out at that time. So again, I'm assuming that somebody has an interest rate of 3.5% or 4%, and interest rates today are in the sixes. And so you would want to try to take over their loan. Now, not every mortgage is assumable. VA loans are assumable. So if you are purchasing the home from a veteran who used their VA eligibility to purchase that home, then you could assume their loan if they are willing to do that. Now, a lot of times the vets don't want to do that because if they allow you to take over their loan, it does not open up their eligibility to be able to go and finance with VA again. So sometimes it works out great. Some loans, so the majority of loans that are assumable, that would be a conventional loan, are going to be adjustable mortgages. So a fixed 30-year fixed Fannie Mae conventional loan is not assumable, and it's not even in the paperwork. So you're looking at adjustable rate mortgages, typically in a conventional situation, that would be an assumable loan. So Chad asks the question, what are the tax implications of selling a rental property to purchase a primary residence? So that question actually needs to be answered by your CPA, because depending on how long that you've owned the property, how much depreciation that you've taken against that property, how much that you've put in money to that property, versus how much income that you've earned on it, will determine what your tax implications are. So I am not a CPA, and I can't actually give you an exact answer on that, but I would advise that you call the CPA if you have a rental property that you are thinking of selling, liquidating it, taking the cash, and then going and buying yourself a primary residence. So definitely reach out to your CPA, because they've been doing your taxes. They know what you guys have filed every year. They know how much income that you've brought in on the property, and they know what kind of depreciation that you've written off. So it's not an easy answer. It's actually a math calculation. And then Carrie jumps on and says, great info. Hi, all. So Carrie, thanks so much for joining us tonight. Sure do appreciate it. And I love these questions, you guys. Please, this is great. Keep them coming. I don't want anybody to not get the information that they need. And a lot of times I'm giving you the information that I think you need, but it's not necessarily what your question is in your head. And if you have that question, chances are that many others have the same. So please keep it coming. I really do appreciate this. I enjoy it. I love it. So now I talked about what the benefits of homeownership are. Now we're going to go to the next slide. Benefits of homeownership, but let's talk now about your responsibilities of homeownership, what I like to call is #adulting. So you do have to make on-time mortgage payments with your rent. Most landlords, unless you're in a big giant complex of an apartment building, most landlords do not report your rent payments to a credit bureau. So if you end up making your payment late, that's not going to be reflected on your credit report. If you make your mortgage payment 30 days or more late, that is going to immediately hit that credit report, and you will see your credit score drop immediately, and by quite a bit, significantly. One 30-day late payment can change that credit score by 80 points and sometimes more. Property taxes, you are responsible to make those property taxes. So the majority, the payments, right? You've got property tax payments. The majority of my clients, especially first-time buyers, will include the property taxes in their monthly mortgage payment. Like I talked about when we were talking about buzzwords and escrows or impounds. That means you're impounding, you're including those property taxes and that homeowner's insurance in your monthly mortgage payment. But some people choose not to do that, and they choose to pay them separately. You can do it however you choose to do it, which is absolutely fine if you have at least 10% down payment or more. Or if you're doing an FHA or a VA loan, regardless of how much money that you put down, they require that you do. However, if you're a conventional loan or a jumbo loan and you wanted to pay those taxes and that insurance separately, you absolutely can. But if you don't make that payment when it is due, you could lose your property for not making that payment. The insurance is very important. If the insurance policy does not get kept to date and your insurance were to lapse and you have no coverage and your home burns down to the ground, you are going to have a mortgage that you owe and you're going to have no house to live in. So it is very, very important. You need to be a big boy, big girl, big, person, and you need to make sure that you're keeping all of those things paid and up to date. You have repairs and maintenance. So no longer can you look to your landlord and call them up and say, the refrigerator isn't working or the washer and dryer broke, if those are things that are included in your unit. You can't call them up and say the pipe broke. You got to send out a plumber. There's nobody responsible but you. So you do need to make sure that you've got a separate account put to the side that is going to take care of those unexpected expenses when things like that do occur, because you are the part. If you have HOA dues, if you buy a property, a home, single family that has HOA, or you buy a condo or a townhome that has HOA dues, you do need to make sure that you stay up to date with those HOA fees. If you do not pay them and you do get far behind, your HOA or your homeowners association can actually foreclose on you. It is possible. So you do want to make sure that you're keeping up to date with all payments that are due, for your property. So those are the responsibilities of homeownership. Okay, so you guys now have your benefits of homeownership. You've got your responsibilities of homeownership. And I can see that it looks like I've got another question that says, how can we negotiate for the seller to pay the closing costs? So that we're going to actually get into a little bit further down the road in the workshop, where I'm going to be talking about selecting your real estate agent. It is very, very important that you are selecting the right agent that is going to help you negotiate. So we're going to actually get to that one. And then, and that was Rolando. And then Chad asks, how soon after closing on a property can you refinance to take advantage of a lower interest rate? So that's actually fabulous. I love that question, especially right now in higher rate environment. There are no prepayment penalties on any owner occupied mortgage product. So regardless of the loan type that you take, VA, USDA, jumbo, conventional, even if we go into an alternative document like a bank statement product, there are no prepayment penalty fees that are allowed to be put on a mortgage when it is your owner occupied residence. So that means that you could close your loan and you could go the next day and you could apply for a new loan and you could refinance to drop your interest rate. Now, we obviously don't want you refinancing 100 times. Refinances are not free. You're going to hear a lot of people, when interest rates do come down, they're going to advertise that it's a no fee refi. There's fees. There's always fees. And that is definitely something that will be a workshop that we can do when we're in that rate environment, that it makes sense for that people want to know, should I refinance and what does it cost? There's always fees. They're either loaded up into the interest rate or you see them on the paperwork and it goes through the actual refinance itself. So we don't want to do a refinance unless it makes sense. We want to make sure that you are saving more than what it's costing you to do that refinance, but there are no prepayment penalties on an owner occupied. There's no prepayment penalties on the majority of investment property loans, but there are some not standard loans. They're called non-qualified mortgages. So basically they're more like an alternative document or a subprime loan. People have lots of names for them. Those may possibly on an investment property have a prepayment penalty, but you would not have a prepayment penalty on an owner-occupied residence. And Rolando says, thank you. All right. So I think we're good. We're going to jump into the next one, which is how do we determine what loan type is best for you? So keep those questions coming. I love it. Okay, so this next slide in our workshop is how to determine the loan program that is best for you. So this is where all of those FHA, VA, USDA, conventional, bank statement, jumbo, you're hearing everybody talk about all these different loan programs, even reverse mortgage. And we're not going to get into all of those today because you guys would be here for hours and hours, and I don't want to do that to you. We're going to hit the basics today. We are going to talk about FHA and conventional as well as VA, and we're going to hit on USDA. The rest of the programs, if you're a jumbo borrower, so you're buying outside of county loan limits, or you need a bank statement loan, you're self-employed and you can't show tax returns, those are things that we can absolutely do as a one-off, that you can call me, you can get a consultation, you can go to the website, you can book a call, and I can talk with you about those other programs that are available and do a one-on-one. But how do we determine which loan program is best for you? You come to me and you say, I'm a first-time buyer. I want to put as little down as possible on on the home that I buy. And, I don't know if I should do a conventional or an FHA. So we're going to determine which program is best for you based on where you fit. So your credit score. So where is your credit score? How much money do you have available for down payment? Those things are all going to work into what which loan program are we going to put you into? What kind of property are you buying? Are you buying a primary residence? Are you one of those people that have decided that you're going to stay put where you are? You love where you live. Your rent is a great number, but you want to still own something and buy something. You're going to buy an investment property. So depending on you and your situation is what is going to determine which loan program works best for you. An FHA loan is going to allow you to have a lower credit score than a conventional loan. A VA loan, obviously you need to be a veteran in order to qualify for that benefit, but that's going to be a zero down. The credit score can be much lower. So we're going to determine where you are and then what program works best for you based on all of the different situations that we're going to look at. The property type, where is the property located? Are you in a rural area? What is your credit score? How much down payment do you have available? So there are conventional loans that have 3% down, where an FHA loan is 3.5% down. So that's where people go, well, I don't understand, which one do we want? So we're going to select and determine based on you and what you're trying to buy and where you're trying to buy and how much you have available to put down which program is best for you. But here on the screen, you guys can read that. And I've got a bunch of little bullet points there. And like I mentioned in the buzzwords, you guys can always pause this and reread it and go line for line, just so that it's making sense in your head. But we are going to go on to those loan programs so that we can talk about each program. And that's going to kind of help you also to kind of determine in your mind which program do you fit within. Okay, here we go. Loan programs. So like I mentioned before, we're going to talk about the most important loan programs, which most of the people that are on this workshop today are going to be first-time buyers. Many of you, the majority, are probably going to be trying to get in with a minimum down payment. So these are going to be the most important ones that we are going to talk about today. So we're going to talk about conventional, which you'll also hear people refer to as Fannie Mae and Freddie Mac. We're going to talk about FHA, USDA, VA, and then I have a jumbo picture on here and I'll hit it really quick, but we're not going to actually go too in depth into that. I saw a question come in from Lauren. She says, I have an FHA loan. What are the requirements to purchase a second property as an investment? Any low minimum required down payment? Thanks. So if you're looking to purchase another property as an investment property, you already own the home that you live in, and now you want to start building your real estate portfolio. You need to make sure that you have down payment available in that situation. Investment property purchase loans require a minimum of 20% down. The majority of the loan products that are out there are going to be 25% down. We do have some at 20, but the interest rate is going to be significantly higher when you're 20% down versus 25% down. So what I always suggest that my clients do is actually, I don't want them to buy a home and live in it and then start acquiring investment properties. I want you to go the opposite direction, which you're already in your home. And we can talk to you about how we could maybe strategize to figure out how to make this work for you. But for anybody that is on here who is a first-time buyer, I want you to start by buying something that's going to work for you today, not something that is going to work for you when you're a family in 5 years from now. And hear me out on this one. So if you live in a 1 or a 2 bedroom apartment right now, I want you to go and I want you to buy a 1 or 2 bedroom condominium, because every time that we move up, we can do another owner occupied. We can hold on to the one that we have and we can rent it out while we go do another owner occupied, which allows for those lower down payments, not investment purchases where you need the big down payment. So you buy the 1 or 2 bedroom condominium. Then you go and you buy the 2 or the 3 bedroom townhome. Then you go and you buy the 2 bedroom single family. Then you go and you buy the 3 bedroom single family. And you can do many different directions. Obviously, this is just kind of an example. But if we can start small and we can then hold that property and come up with another 3 or 5% down, and go buy the next owner occupied and then rent that one out and then go buy the next owner occupied. Now you're building a portfolio, but you're getting primary residence interest rates and you're getting primary residence down payments. Now, don't take this the wrong way. If you do a primary residence purchase and you're doing the mortgage, you are saying that your intent is to occupy. So I'm not by any means saying that we buy one and stay there for a month and then go buy another one, and we do this quickly. My thought is you move into it and you live in it until you're ready for the next bigger property. So maybe a year later, then you're ready to go and buy the bigger one. And then maybe a year after that, you're ready to go and buy the next one. So don't take that out of context, but that would be the very best way with low down payments of being able to obtain, and achieve a real estate portfolio. Okay, so FHA, you can see on my screen that it is going to be a 3.5% down payment. Now, if you scroll down a little bit, I've got all of those little tabs there, but the loan limits do go up to 1.149825. Now, this is for high cost areas, and every area, even if considered high cost, that loan amount might be slightly different. So, for example, in Ventura County in California, it is not going to be that 1.149, but it will be higher than the average of 640. Which you would see in Riverside or San Bernardino. That is not a high cost area, but it will go up to loan limits of 1.149825 with only 3.5% down. So you're really looking at a loan amount of, or a sales price of about maybe like 1.25, 1.2. I'm sitting obviously here live with you guys, so I'm not doing those numbers, but your loan balance could be that high if you're in a high cost area. You can do a refinance with FHA, which a lot of people don't know, and you can get cash out up to 80% of your value. The mortgage insurance premiums are very good. They're actually quite low. In 2022, they did lower that monthly mortgage insurance premium to be lower than what it used to be. So it is now starting to get very competitive with conventional loans. And on average, we see that those interest rates on FHA are lower than what we would see on a conventional product. So FHA is really a great loan. It's especially good if you have a little bit lower credit score. The interest rate is going to be pretty much the same for all borrowers. When we start to get into credit scores that are below 620, we're going to start seeing that interest rate go up. We could do a loan amount for somebody as low as 550, but that interest rate gets really, really ugly. So really 580 and above would be our better place to be for your credit score as far as interest rates are concerned. So that's why I do have on their minimum credit score 580, trying to keep you within a good range. The interest rate will actually be a lot higher if you're a 580. It gets better at 600, gets a little bit better at 620, gets a little bit better at 640, and then everybody 640 and above pretty much get the same interest rate. So again, FHA is really good for those lower credit score borrowers. Everybody is going to get the same mortgage insurance premium. So whereas with conventional, and we'll talk about that in the next slide, conventional's mortgage insurance premium is much like shopping for car insurance. It depends on you. And so we'll talk about that. It can get pretty pricey. But with FHA, everybody gets the same premium, making the mortgage insurance premium a bit more affordable. So I really, really do love the FHA loan program. I like to call it the do-over loan because they are more lenient with credit guidelines. If you have collection accounts, if you had previously had a bankruptcy, if you had previously had a foreclosure or a short sale, the time frame that you need to wait is significantly shorter than what is required for a conventional loan. So for example, if you've had a bankruptcy and you did a Chapter 13 where it was actually where they reorganize your debt and you're making a monthly payment, even while you are in bankruptcy and you have not been discharged yet, if we can show that you've made 12 months of those payments on time, and the court will allow you, they just have to give permission for you to do the purchase or even a refinance, you can actually get that FHA financing. With a Chapter 7 bankruptcy where the debt basically gets wiped away, if there were extenuating circumstances, and we can talk about you and your scenario and does it fall into extenuating, you could actually do a loan after 1 year from the discharge date. And if it was not extenuating, so it was financial mismanagement, management, we could actually do that within 2 years. So much shorter guideline timeframes for previously bad credit. So FHA is really a great loan program, and a lot of people do misunderstand that FHA is only for first-time buyers. It is not. Anybody can get an FHA loan. Typically, you cannot have another FHA loan outstanding, but there are some exceptions to that as well. So if you feel like you're an FHA borrower, it's definitely something that we'll talk about you and figure out if this is the right program for you. Okay, so I love FHA. FHA is such a great program. It truly is. And if you feel like that is the loan program that you need, then obviously we're going to talk to you and work through it, show you the differences in monthly payments and whether or not it makes sense. And so we'll talk about conventional as well in the next slide. But before I do that, I can see that, and again, my eyes are so bad when they've got your names in red. It looks like Emiz. I'm so sorry if I pronounced that wrong. But it says, how much is the low down payment for one owner occupied investment home to start? So if you're buying, an owner occupied is not an investment. So again, keep that in mind. You're buying the owner occupied to live in it. Then of course, after a year or so, if you choose to rent it out and go buy another, that is absolutely acceptable. But an owner occupied down payment will depend on the loan program. So that's why we're going through programs right now. FHA is 3.5%. Conventional will allow 3%. So it depends on the loan program that makes sense for you, how much that down payment amount will be. But they are very low down payment, percentages. There's also some, it depends on the state that you're in, the county that you're in, what the down payment assistance programs are that are available, but we could also dive into that. So if you were a little bit short on the money that you needed for the down payment that is required for the loan product that you need, there could be some options to get some help with down payment assistance. So that is something, again, that's more of a one-off that we want to do a consultation with you, talk with you on the phone. We need to know what your income is annually so that we're making sure that we're looking up the right programs. What is your credit score? But it's all a conversation to kind of determine what the loan product is that you fall within. Where are you going to fit best? It looks like it says, why not? I love that. That's such a great name. I could actually read that one. Is it true that if you haven't purchased a home in 5+ years, you are eligible for first-time home buyer benefits? So actually, it is 3 years. If you have not owned a property, not been on the title of a home for at least 3 years, you are actually considered a first-time buyer. And then I did miss one question. Same guy. He says, same why not? I love it. Earlier, you mentioned obtaining a loan if you have your own business and can't show taxes. I'm starting a business, so how long do you have to be in business to be able to use it as an income source? So it depends, again, on the loan program. The majority of loan programs, if we're doing a full documentation loan, which is what an FHA or conventional, the USDA, the loan types that we are discussing today, these are all full income documentation loan programs, low down payments. So you have to qualify, which means you're going to provide me with 2 years of your tax returns. So until you have actually filed 2 years of self-employed taxes, you would not be eligible to utilize that income towards qualifying. Now, obviously, there's other programs. There's alternative documentation programs that we can absolutely assist you with. And that would be something, again, like I'm telling everybody, get the consultation, book an appointment on my website, talk with me or one of my girls on my team, and we can discuss your situation and what you need, and then determine which loan program would best fit you for right now. Just keep in mind that those alternative documentation loans, like a bank statement loan, where we are actually calculating income based on the deposits going into the bank account, those loans do require larger down payments. There are some that they advertise as 10% down, and I've got access to them, but the interest rates are so ugly, I'd never put you in that loan product. So you really, to get into a decent interest rate where it makes sense to move forward with that loan type, I would really say you need 20% down to do that type of a loan. So anything that's going to be an alternative documentation type of program, expect to have to do a larger down payment. Um, so, all right. So let's go to our next one, which I believe we're hitting conventional. Okay, so on to conventional. So some people will call it conventional. Sometimes you're going to hear conforming. Sometimes you're going to hear Freddie Mac or Fannie Mae. It's all conventional financing. The FHA is a government program. This is not. So a conventional loan is going to have obviously different guidelines that we have to underwrite to. The down payment minimum is 3%. The majority of those conventional programs that are 3% down are typically first-time buyers. There are one or two that you do not have to be a first-time buyer, but you cannot currently hold real estate, another property with financing on it. So most of the time, if you have already purchased a home before you are not a first-time buyer, conventional will usually want 5% down. But if you are a first-time buyer, there are 3% down options available. As I mentioned before when we talked FHA, conventional is going to be shopping for that mortgage insurance premium. And sometimes it can be cheaper than what we would find for an FHA. So what are those circumstances that we would see that? So they are going to be looking at all pieces of your loan application, your debt to income ratio, your credit score, how much money that you are putting down on the property, and what type of property that you are purchasing. So condo, single family, 3-unit, 4-unit. 2-unit. So based on the scenario will determine what the mortgage insurance premium will be on a monthly basis. So sometimes if you've got a 740 credit score, 10% down payment, low debt to income ratio, you're purchasing a single family home, you've got multiple persons on the application. So when you have more than one borrower, a lot of times we'll see that premium a little bit lower. So sometimes we can get that conventional mortgage insurance premium to be less expensive than FHA. But many times FHA still turns out to be the best option. And again, that's where we have to talk to you. We have to do that consultation. We have to figure out what you've got going on to determine which loan product that you are going to fall within the best. Conventional loans can be great because unlike FHA, if you're buying a condominium, for example, the complex does not have to be approved FHA like an FHA would have to be. So if it's not already approved FHA, then you may want to go to the conventional financing. So again, we kind of figure out what are you doing to determine which loan program is going to work best for you. You can close it as a first and second combination. It's not something that we do very often anymore. It used to be very, very popular about 10 to 15 years ago, not as popular as it was back then. Because, some people might want to do 10% down payment, for example. So they have 10% down. There is no mortgage insurance on a conventional loan if you have at least 20% down payment. So if you wanted to get to that 20% down payment, an option would be you put in 10%, we do a loan for 80%, and then we do a second loan for another 10%, which would be removing the mortgage insurance premium. However, nowadays, when we look at the rate sheets and the pricing, there is an increase to the interest rate when you do introduce an additional lien. So it has turned out to work out most of the time better for the client to just do one solid 90% than to do two separate loans, even with the mortgage insurance premium. But it is an option. It is there, and it is something that can be utilized, and it's really good. And we do still utilize it often if we have a buyer that is trying to buy in more of a jumbo price range and they don't quite have the down payment requirement for a jumbo loan. Usually a 20% down payment is required for those. So you're outside of those conventional loan limits. Then we might want to do a second to bridge that gap to be able to still get them financing on the house without the 20% down payment that would be required. So it does come in handy sometimes. And again, it's about you and what you're trying to do and whether or not it makes sense. Loan limits, I didn't say this in the FHA in the previous slide, but loan limits, I did actually, I did get to it. Loan limits can go up to 1.149825, again, in high cost areas, and the area does matter. So it's not always you're just labeled high cost for your county, wherever it is that you might live across the country. Every county is going to have a different limit, but the maximum high cost for an area like Los Angeles County, Orange County, Hawaii, areas of Hawaii, are going to be that 1.149825. Now, when we do get into those high cost limits that are going to be beyond the county conforming standard number, you do need 5% down. We're not going to see 3% down on those. We do have more lenient guidelines than a jumbo mortgage. So like I just explained, we might want to be looking at doing a first and second combination if you're trying to get into a more jumbo sized property as far as sales price goes. So a little bit more lenient guidelines than what we would see in a jumbo. Lower credit scores are allowed, lower reserves or even no reserves are allowed, where the jumbo is going to get a lot more strict. The minimum credit score for a conventional loan is 620. However, the interest rate is really ugly at a 620 credit score. So we really want to see our conventional buyers really have at least a minimum of 660, 680 really being a better place to be if you're looking for conventional financing and above. The interest rate does get better in 20-point increments. So your credit score at 680 will have one interest rate, 700 will have a different interest rate, 720 a different interest rate, and so on. So again, conventional is going to be a little bit more restrictive than FHA, a little bit higher interest rates, possibly a little bit better in the mortgage insurance, a little bit more opportunity in the condo market. So we have to talk to you about what you're doing to determine which program is going to be best for you. Okay, so one thing that I didn't mention in that slide, and I do want to mention it really quick, is that there is an opportunity to have less than 20% down payment with a conventional loan and to not pay mortgage insurance. You do have to, it's there. It doesn't, it's never, there is none. But you can actually choose to buy out the mortgage insurance. Sometimes that makes sense. So if I have a client that's got 15% down payment available, they can't quite get to that 20% mark. They just don't have quite enough saved. Sometimes it is less expensive in the total monthly payment if we do 10% down and then utilize some of that 5% that's remaining to actually buy that mortgage insurance out, which means that you're basically paying for it in advance, but it's helping you in the monthly income or the monthly, payment to make that lower. So again, everybody is so different that there's not one thing that is right or wrong. It's about the individual and what works best for them. And that's where we need to figure out and determine, what are you buying? Where are you buying it at? How many units is it? What's your credit score? What kind of income do you have? How much cash do you have available for the down payment? And then we're going to kind of figure out where do you fit the best. I did see a question from Allie come in that says, I work in public institution that allows me to have loan forgiveness. When talking about debt to income ratio, is it wise to look into getting into a home until the debt has been resolved? So I'm going to go out on a limb here, and Allie, you may have to actually put another comment in the feed, but I'm guessing that what you're talking about is that they are going to maybe forgive your student loans, or they're going to pay those student loans off for you. So maybe currently you have student loans and you're making payments, but once you've been with the employer for a certain amount of time, or once you get certain certifications, and this is kind of how some of the employers do work, especially we see it a lot in the school system, and then all of a sudden they will actually take care of those student loans for you. They basically pay them off on your behalf after you've been with them for a certain amount of time. So that's the direction that I'm going to go when I answer this question. But if I'm wrong, please put it into the chat, kind of explain a little bit further. But it is really important to own a house. And so, as I mentioned just a little bit ago, and I said, like, the best strategy you could possibly have would be to buy something that you can afford today and then save up money and then go buy the next, and then save up money and then go buy the next. So, if you can afford today with the payments that you have to buy a property and something that is sufficient, that works for you. I'm not telling you to buy a shoebox. I'm telling you to buy what works for you. And if you can afford to buy what works for you with those student loan payments, then do it and get what you need. And then when those student loans have been forgiven and your cash flow monthly, grows a little bit more because now you don't have those to pay, then you can use that same money to save more and then take that savings and then go buy the next place that's a little bit bigger. But it's never bad to buy, ever. If you can't find what is sufficient for you, so maybe you're not with that debt monthly qualifying to buy what you need, then I would tell you then obviously it's best to wait until you get those paid off, because now that's going to help you to qualify for more, helping you get into what you need that will take care of your family. So it does depend on what you qualify for now and if you can get what you need with those loans. But if you can qualify to do something with those loans in place, I would highly suggest it. You guys, the property values aren't dropping. They're not dropping. Everybody was waiting for it to happen. Everybody thought that things were going to, we were going to see a big recession happen. I even believed we were probably looking at a recession coming. I just figured if interest rates went up that high, it was just going to be absolutely impossible to keep home values high. And what actually ended up happening was that everybody that took advantage of either a purchase or a refinance during 2020 and 2021, their interest rate is just so darn low that there is absolutely no reason to sell. And they are staying in their homes instead of doing the normal turnover that you usually see in the real estate market. People are retiring and selling and moving into something smaller. People are getting married and they're, selling their condo and they're buying a home because they're, planning for a baby. The normal turnover of selling and buying, it just literally kind of got just put on hold because everybody said, well, it's actually cheaper for me to just stay in this big, huge house, even though all my kids are gone, than it would be for me to sell and go buy something else. My payment would be more on a smaller house because the interest rate is higher. So with that, and with very, few sellers listing their homes for sale, that has really guarded against that depreciation. And we've actually seen appreciation even in a market where in normal times we would usually see home values drop. So, once those interest rates come down, which they're already starting to do, we've already seen a really nice drop in interest rates since December. And we actually just yesterday and today saw another nice drop. As the interest rates drop, more people are going to be ready to make that plan and to execute on it that have been just sitting on hold. And so, the interest rates are going to drop. More people are going to be ready to move. We'll see more inventory, but we're going to see a lot more buyers and there's going to be a lot more competition. So it's definitely better to purchase something if you can and reap the rewards of that appreciation. And when interest rates come down, refinance it, get into a better payment, save money, go and buy another one. That is definitely, the best plan that you can make. So with that, we're going to go on to VA. Here we go. Okay, so VA. VA is by far my favorite loan program ever. We do a lot of VA in my office, and it is really important. One thing I want to say before I start getting to bullet points is you need to work with somebody who has done VA before. So if you are a vet, obviously, many of you that are on here today are not necessarily veterans, and this is not a program that you would be eligible for. But if you are a veteran, number one, please make sure you are working with a lender that does understand VA loans. Number two, make sure you are working with a real estate agent that understands VA loans. It is very important. And if you are a vet, happy to do a one-on-one off the side, not part of the workshop consultation with you. We want to make sure that you understand everything that does go into VA and what you need to be writing into your contract, because there are some elements that are a little bit different than a normal transaction. However, VA loans are fabulous. If you are a seller and somebody walks in and they have a VA loan, you should definitely consider looking at that person's offer. A lot of times agents will get a little bit spooked. It's zero down payment. They don't really understand how they work. They seem to think that the appraisal is going to be a little bit more difficult, when in essence and in reality, many of the guidelines have changed for almost all loan programs, and that VA appraisal is not going to be any different with what they're looking for as far as health and safety standards, and it would be for an FHA or even a conventional loan. So VA loans are fabulous. You can go to zero down payment. A much, much higher debt to income ratio is allowed, so it makes it a little bit easier to get approved for a VA loan. There is no mortgage insurance, so that goes away monthly, making it more affordable. Our interest rates are much lower on VA loans than any kind of a conventional or a jumbo product. There are no loan limits for VA, so I've actually done $2 million VAs with zero down payment. So again, I mean, it's just a fabulous program. It gives you the opportunity to do a refinance with no appraisal required. We just basically have to verify your employment. We're not even grabbing W-2s or tax returns to do that refinance if interest rates do drop. So it's a very speedy and inexpensive refinance to get a better payment. The closing costs are reduced for you. So we do reduce the fees from the lender to help you to get in, because you are a vet and you have fought for our country, you have served for our country, and it is something that you do deserve. It is assumable. It is an assumable loan, which is also really great. We're starting to see a lot of that in today's rate environment, where we've got a vet that does want to sell the property, and they got into an interest rate that was in the 3s or the 4s, and they can actually offer to their buyers walking in and looking at their home that they could assume the current financing that is on the property. So that is really awesome. And it is allowed to do a refinance on a VA loan up to 100% cash out. Now, the different lenders that offer VA financing don't always offer 100%. We see the majority of the lenders are offering a 90% cash out. They just don't feel comfortable going all the way up to that 100%. They feel like there's just a little bit too much risk in it. But the actual guideline from the VA says you can go up to 100% in that cash out. So we may be able to find you a lender that will do that, but in your head kind of think you're going to be able to go cash out up to about 90. But VA loans are fabulous. I do love them. And if you are a vet, definitely give us a call. Happy to work through that with you. And if you have a real estate agent that you absolutely love, but they have never done a VA before, have them call us and we'll walk them through those really important pieces of the contract to make sure that they are writing it accurately. Okay, so one thing I do want to mention, because I had a question earlier in the workshop about the assumable. So one thing to keep in mind if you're going to assume somebody's loan, and I think that it's fabulous if you have the opportunity to do that, why not take advantage of a lower interest rate than what you'd get if you went and found your own financing today. But one thing to keep in mind is that you are going to most likely need to have some cash for that seller. So if they purchase that property in 2020 or in 2021, that property is worth more today than it was then. So they're not going to just let you walk in, assume their loan, and walk away from the equity in their property. You are going to have to gap the bridge of what the value of the home is versus what the loan balance is. You're going to have to gap that bridge in cash. So do keep that in mind. It doesn't mean you get to walk in and assume it and all is well with the world and move on. That could possibly happen maybe if you find an area of the country where property values have dropped slightly. Maybe they might just let you walk in and assume it and walk away. But most of the time, you're going to have to bring in money to gap that bridge. I did get a question I saw from Michelle. She says, is it wiser to make the minimum monthly payments rather than pay a bit extra monthly or one full extra month per year? So honestly, you're doing the same thing in either way. If you make a little bit more every month, which is going to equal to one monthly payment a year, or you make just one extra full payment per year, you're doing exactly the same thing as far as accelerating the mortgage and getting paid off quicker, which means you're going to pay less interest. So I always suggest that obviously if you can afford to pay more, pay more. It never hurts you. You got to look at it like it's a savings account. You're paying money towards the balance of a loan on an asset that you have. So the less you owe on that asset, the more you can get out of that asset should you sell it and need the cash. So you can kind of look at it like it's a piggy bank. Obviously, the more you pay every month or the more extra payments that you make per year will accelerate the mortgage. You're paying it off faster. You're paying less interest. So for example, and again, I'm sitting here, you guys are seeing me do this live, so I don't have an amortization schedule that I can pull up and plug in numbers or give you any specific exact amount of years or months. But the whole thing that everybody's always said throughout all of the years that I've been doing this is basically the general rule is if you can make one extra monthly payment per year or smaller, amount, but every month, that you could shave off about 8 years off of your 30-year note. So it does make a big difference. And I do highly suggest that you always pay more if you can. The exact calculation we'd have to do, one-on-one, and you'd have to tell me what the loan balance is and how much extra you plan to pay. And I can run that amortization schedule and tell you exactly how many months and years that it would take for you to be paid off. Next question, Michelle says, who besides the veteran can qualify for a VA loan as a relative? No, you can't. So a vet is a vet and they qualify for the VA loan. If they are married, them and their spouse can be on the loan together, qualifying for the loan together. And the only time that a VA eligibility gets passed to someone else when someone passes away is if they were actually considered fully disabled from something that came out of being in battle. So they have to have been deemed disabled, and it had to have happened while they were actually serving. So if that is the situation, then in that circumstance, when they pass or if they pass, then their spouse is eligible to use their VA benefit, but that is the only time. People get very confused about VA. There's a lot that goes into it. So any other questions, more than happy to answer. And Michelle says, I meant, shouldn't you save your extra money to grow it in other investments? That's honestly a personal choice. If you feel that you have other investments that you can do more with that money, that you're going to get a bigger return, then that's where you put your money. If you feel that your money is best spent by paying your home off and paying it off faster, then that's where you put your money. That comes down to the vehicles that you plan to put your money in and where you feel that you're going to get your better return on the investment. So some people, they want to get that home paid off. To them, that is their retirement. It means more to them than anything else to get that house paid off by the time that they retire so they have no mortgage payment. Others feel like they're throwing their money away. They're going to let the house work for them and they're going to take their money and go put it somewhere else. Everybody has a different financial strategy, so I'm not going to tell you which way is better than another. It is a true preference. Okay, so I think we're good. Now, I did have a USDA slide, and I believe that I forgot to upload it for you guys. So the actual slide is not there for me to go through it with you, I believe. So I think that the next slide that we're going to jump into is closing costs. So I do want to talk about USDA really quick in case that slide isn't there. USDA is a rural loan. It is for a rural area. So the way that you know whether the property that you want to purchase or if the area that you want to buy in is considered rural is to actually go to the USDA website, or obviously you can contact us and we can look it up for you. USDA does allow a 0 down payment. The income limits for your family are actually quite generous. Depending on how many people are in the home determines what the total monthly income is that is allowed to be eligible for that USDA financing. There is nothing other than the amount of people, the income you earn, where the property is located, and your credit score that deems whether or not you are USDA eligible. You didn't have to serve anywhere. You don't have to be a first-time buyer. You cannot own other property. So if you have another home that you own, you are not eligible for USDA. So you cannot own another property. Now, you don't have to be a first-time buyer, but you cannot own other property, any real property. So that's kind of what gets you into USDA. It is really a great program, especially for a lot of people that were choosing to move. They wanted to get out of the city. They were all leaving in droves, and they were going to other places. So if you're moving yourself out and you're going into an area that is more remote, there's a good chance that it is considered rural and would be allowable by the USDA to get financing in there. So if you are interested in that and you'd like to know if the area that you've been looking at would be considered an area that would work for, just give us a call. There's lots of areas that you may not even think would be considered eligible, and they are. So the best thing to do is to just ask. So we're going to go ahead and jump into the next slide. I do believe that it is closing costs. I am about 99% sure. I forgot the USDA slide, but if that USDA slide does pop up, we're going to just stop the video and move on to the next so that I don't waste you guys' time. So here we go. Okay, so on to our next part of the workshop, closing costs. So usually in my workshops, I will actually throw up a closing cost estimate, and I'll go line by line with you guys and show you what every single closing cost is and what every single closing cost means. But because this is YouTube and this is Facebook and this is anybody can jump in and watch and learn and be educated no matter what state that they are in, county or city, I don't want to do that because it really does change based on where you live in the state that you are in and the county that you are in. Just like I mentioned at the beginning of the workshop, depending on the county that you're in and the city that you're in could determine, and actually state, right? State could determine if you're an escrow state. State could determine if you're a title state or if you're an attorney state. So I don't want to give anybody information that is inaccurate. So I'm not going to take us through an actual closing statement. But I do want to tell you that consultations are free of charge. We are happy to do a one-on-one with you. We are happy to give you the education. Me or any of the girls on my team will take you through an estimate one-on-one with you. We can do it via Zoom so that you've got that estimate in front of you, or we can email you the estimate so that you are opening it up and looking at it on your computer screen while we have it up on ours. And we will take you line by line and explain what every single cost on that estimate means. So please keep that in mind, that you are more than welcome to reach out to us and ask us for that. We will do that for you. You can go straight over to my website, to mortgagemomradio.com, click on that appointment button and set yourself up with a consultation. We're going to call you. We're going to talk to you. If that is something that you want, we will then schedule a second consultation with you so that we can prepare that estimate and then send it to you, email it to you, and then everybody get on together to go through it together. So that is an option. It is an opportunity to you. And I want to make sure that you do know that. And there is nothing that we do that costs you money. We are here to educate. We are here to help, and we are here to make sure that you are learning. So please don't think that anything that you do by reaching out to my office is going to cost you. It is not going to cost you. We do not get paid unless you actually close a loan with our company or with our office. So that is never something to be concerned about. But what is very important for you to know is that you don't just have your down payment. And I have a lot of clients that get sent to me after an escrow is already opened. They were pre-approved with another lender. They thought all they needed was their 3 or their 3.5 or their 5% down payment, or they were doing down payment assistance and thought the down payment assistance help was going to cover the down payment. They had no idea that there were closing costs or what they needed on top of that down payment amount. So please keep in mind that on average, and again, every single state is different. Costs are different depending on if you're an escrow state, title state, attorney state. and the state in itself, the cost of the property that you're purchasing. All of those things are going to depend. The city and county, sometimes there's transfer taxes that are paid, sometimes there are not. So every single county, city, and state will give you different closing costs. So on average, a really good number that I tell my clients to have in the back of their mind is to expect an additional 2% in closing costs of their sales price. So if your sales price is $500,000, expect $10,000 in closing costs. Now, if you've got your 3% saved or your 3.5% saved and you cannot afford that extra 2%, you can negotiate with the seller as part of your offer that you make in your contract to ask the seller to pay your closing costs. They don't have to necessarily pay the whole 2%. You might get to a point where you're negotiating and they'll pay 0.5% or 1% or 2%, or you might even be able to get 3 or 4% in a credit from a seller. So just keep in mind, I don't want anybody to be blindsided. There are closing costs. They do have to be paid. There is no way around them, but you can negotiate to get them paid for by your seller. There are ways for your lender to help you with those closing costs. You cannot finance them. Closing costs cannot be financed unless, like we talked about before, it's a USDA loan and your appraisal comes in higher than what you negotiated in your contract. That is the only loan program that allows you to do that. So they cannot be financed, but your lender can give you a credit, a seller can give you a credit, or you do have to make sure that you have saved for them. So please don't misunderstand that it is not just your down payment. And if you would like to do that one-on-one with us, go get your consultation, sign up for it, go to the website, book an appointment. We will talk to you and we will make sure that we take you through it so that you are ready and you are prepared. Okay, so one thing again, I forgot to upload the slide for USDA is the only loan program where if your appraised value happens to come in higher than the negotiated sales contract, the difference can be utilized to help you pay towards closing costs. So let's say that you negotiate $400,000 on your price and your appraisal comes in at 402, then you have an extra $2,000 that can be utilized and you can help you finance those closing costs. But that is the only loan program, but it is one of the benefits of the USDA program. I did see I had a question come in. So let's see, where did it go? Here we go. Is it possible, so this is from Why Not, is it possible to buy a home for business use, but you also use it as your primary residence? So it is possible to do that. There are properties that are considered mixed use. Many times you'll see the actual business is down below and then the home is up above it. That's a lot of times what you'd see in a mixed use. Many times it's like retail stores or doctor's office or, whatever that it is that you might be running out from underneath. And then you've got your living quarters up on top. So there are mixed use properties. Those mixed use properties, the property itself has to actually be a mixed use per title. So it does have to be categorized as mixed use. And in that situation, you could get residential financing to help you if you are looking to purchase just a single family home and you are going to live in that home, but you're going to also run your business out of it because you work from home or, you work on a computer and you don't necessarily need like a retail location. Obviously, you can always buy that home because you're living in it. It's your primary residence. But if you're looking for something more commercial, like a warehouse, then that's going to actually be commercial financing. And that is not something that I do. We do residential only. So even if you're buying investment properties, that's okay. But we do residential only and up to 4 units. Anything beyond 4 units. So if you were looking at a 5 or a 6 unit building that you wanted to buy, even if you planned to live in one of those units, you would still need to get commercial financing. And that is just a whole nother set of rules, guidelines, credit scores, down payments. And so, you can only be good at so many things. I specialize in residential. I don't get into commercial. So you would want to find a commercial lender if you're not looking at one of those mixed use properties or just running your business out of one of the bedrooms of the house or whatever. Let's see. Next question came in. Can closing costs be paid by a family member as a gift? And somebody else, Heather's saying sound is off, Mikey. I'm not sure why she's saying that. I see the sound moving. If anybody else is out there that can't hear me, please say something. But I'm pretty sure maybe it was just Heather. Okay. So Laura says, can closing costs be paid by a family member as a gift? And yes, they can. Closing costs, you can get a gift on a primary residence, not an investment property, but on a primary residence or a second home vacation property. You can get a gift to help you with down payment, closing costs. That is all absolutely acceptable. Not a problem. All right. So I don't see any more questions, but keep them coming, guys. Okay, so keep them coming, and we're going to go ahead and jump into the next slide, which is a pre-approval. So in order to get pre-approved, what is it that we need from you? So here we go. Okay, so we have gone through buzzwords. We have gone through loan types. We've talked about closing costs. Now we're going to talk about your pre-approval. So everything sounds great. You are ready to get pre-approved. You've learned from the workshop today that you actually have the opportunity to buy. And we are going to talk about now, what do you do? What do we need from you? So what we need to get from you is completely different based on what kind of job that you have. So if you are a W-2 wage earner, you are employed by a company, you don't own the company. If you own the company and give yourself a W-2, you are not a wage earner. You are not a W-2 employee. You are still considered self-employed. So that gets very confusing for people, so keep that in mind. But if you are a wage earner, we are going to get 1 month of pay stubs, 2 years of W-2s, and we are going to get the final pay stub you received at the end of each year for the last 2 years. And so that doesn't mean the pay stub that got paid out in first week of January that covered through December. We want the last pay stub you received, cash in your bank account in that year. We want the last 2 years. So right now it's 2024. So I want that final pay stub from 2022 and that final pay stub from 2023 so that I can see if you had overtime. I can see if you had any kind of commissions, bonuses, anything that you might have received, vacation pay or sick pay. We want to see everything that you received within the year, and that is typically broken down in that final pay stub that you received in those years. So 1 month of pay stubs, 2 years of W-2s, last 2 years of final pay stubs. If you are self-employed, now this is if we are doing a full doc normal loan, FHA conventional, jumbo USDA. We have all kinds of alternative options available for self-employed borrowers. Many people don't realize we could do bank statement programs where we're going to look at your last 12 to 24 months of bank statements to determine your deposits, which we will then calculate what your monthly income is. So if you're that guy that writes everything off, or you're that girl or that writes everything off, that's okay. We've got products for you, but that's not what we're discussing in today's workshop. Happy to do a one-on-one consultation with you as well so that we can talk about you and can we get you guys into a loan even if you do not show the income that you earn, which is very, very standard for many self-employed people. But let's talk about self-employed, assuming you're trying to do a conventional USDA, FHA, or a VA. We do need your last 2 years of self-employed tax returns. If you are a corporation, you are an S Corp, you are a C Corp, we also need to get, or an LLC, we also need to get your tax returns from the businesses if you own more than 25%. If you own less, if you are a partner, we are just going to get your K-1s on top of your personal tax returns. And we do need to get a profit and loss. So we need to get a year-to-date profit and loss. So it begins at the beginning of the year and through the end of the year. So right now it's March. Actually, it's March. Oh my goodness, it's March. Many of you have not filed tax returns yet. That's okay, but I need a profit and loss for all of 2023. And then I need a year-to-date profit and loss through today's date, 2024. And then all borrowers, everybody, whether a wage earner or self-employed, will need to provide us with a copy of their driver's license, copy of their most recent 2 years bank statements, that are going to be utilized for down payment and closing costs. If you're going to utilize your retirement accounts for down payment or for maybe reserves, depending on the loan program, we will need to get the most recent quarterly statement that has printed. Most retirement accounts do print quarterly, not monthly. And we will need to get the terms and conditions of withdrawal. So just because you have a retirement account doesn't always necessarily mean that you have access to the funds, that you could pull out the money to utilize it for a home purchase. So we will need to see the terms and conditions of withdrawal for that account so that we can see that you do have access to those funds. Okay, so I did make a mistake and I said 2 years bank statements. We don't need 2 years bank statements, not unless we're doing an actual bank statement loan. We need 2 months of bank statements. So your most recent 2 months of bank statements. So Michelle says, is it true that you have to show proof of where your savings come from, that it has been there for at least 2 months in your account? So yes, we have to source all deposits that go into the bank account that are on the statement that are 50% or more of your monthly income. So think of it this way. If you make $10,000 a month in income and you have a deposit of $5,000 in your bank in that month that we're looking at that statement, we're going to ask you to show us where that $5,000 came from. So if you can't tell us where it came from, you can't show us the source. Oh, I got a check from, selling my car, and here's the bill of sale and here's a copy of the check. Or I had a bunch of comic books and I sold the comic books and this is what I got for them. Well, there's still going to be a bill of sale for selling something like that. There's going to be appraisals that were made because those comic books were cool and they were worth $5,000. So we have to be able to source where the money came from when we see the deposits. So if you have cash under your mattress or in your safe at home and you're wanting to use your cash for your down payment, you cannot just go and drop a bunch of cash in the bank. They're not going to allow you to use that money. So you would probably want to know in advance, hey, I'm planning to buy a house in a couple of months, and probably get that money deposited before you have to show us the bank statements. It's the easiest way to say it. Not trying to do anything that is malicious or against the bank rules, but if we see the deposits and you can't source them, then the money cannot be utilized. So don't let us see them. Then I see Why Not says 2 months only. Yes. So yes, if it's a full income documentation loan, like what we're talking about today, these loan products, it's 2 months bank statements, not 2 years. So 2 years, it could be 12 to 24 months of bank statements if we're talking about one of those bank statement loans for a self-employed borrower. So I said it wrong and I do apologize. So keep the questions coming because we are now moving on to contacting a realtor. So you did everything you were supposed to do and you are pre-approved. And now it is time to contact the realtor. So how do you select the right realtor? Here we go. All right, you are pre-approved. Hopefully you've got a Mortgage Mom Radio pre-approval letter in your hand. You know what your maximum budget is. You know how much money you need for down payment and for your closing costs. And you know if you need to negotiate to get some of those closing costs covered. So you are ready for that next step. You are ready to get in the car and start looking at properties. Very exciting. Now is the time that you need to select the real estate agent that you are going to work with. Your real estate agent is the most important piece in your home buying success. You need to identify, negotiate, secure that new home, and it can be very, very difficult in a seller's market like today. So selecting the right real estate agent that is going to work for you is very, very important. We're going to move to the next slide right now because I have a lot of great pieces there that we want to talk about and I don't want to miss out on it. So you do want to have your own representation. Many times buyers believe that they are going to get a better deal if they work with the listing agent. This can be the case. This can happen. It has happened successfully many times, so I'm not going to knock it down and say that you can't do that, but I would highly suggest that you have your own representation. You want to have that person working for you on your side. A real estate agent is responsible first and foremost to the person that they signed a contract with first. So if they signed a contract with that person that has that home listed for sale, their very first responsibility is to that person. You don't want to be their second piece. You don't want to be their side piece. You want to be their most important piece. And so it is really important to select somebody that is going to represent you. They're going to take you out and show you properties. If there's an open house and you happen to walk in without them, that is okay. Just make sure that listing agent knows you've got somebody that you're working with. Builders as well. If you walk into a new home build, a lot of clients don't know that they can work with a real estate agent. So make sure that when you sign in at that, that construction site and you say you're there to tour the models, make sure that you put down that you're working with a real estate agent and you put your agent's name and number. It is so important to have a real estate agent that is working with you and that they are giving you the guidance that you need as a buyer. You want to make sure that they have a vested interest in you. That is really important as well. It is not important what your maximum sales price is that you qualified for or got pre-approved for. What is important is that they are talking to you about your budget, the monthly payment that is comfortable, and that they are trying to show you properties that are going to keep you within your comfort level, not just the maximum price that you can get to. It's also important for them to have a vested interest in you and your family. So is there a certain school district that you're trying to get within, that they are showing you the properties within that school district? Do you not want to have an HOA? Are you concerned that you don't want to be in a home with mellow roofs? Are there a certain amount of bedrooms and bathrooms that are really important to you? They understand that you need to get a credit from a seller as part of that contract when you write it. So they're making sure that you're showing you properties that are going to be conducive to a seller that is going to be willing to negotiate for what you need. So they need to be an expert in your marketplace. They need to be aware if there's any HOA dues. If it's a condominium complex, they're not showing you something that's got litigation, or you are an FHA buyer and that condo's not approved FHA, or that condominium complex is having some insurance issues. You need an expert in the marketplace, and you need somebody that's going to have a vested interest in you and what you need, and they are working for you. You don't want somebody that just hears you're a buyer, here's your budget, and they just start sending a bunch of stuff at you. You want to make sure that somebody is working hard to only show you properties that are going to work, because the last thing that you want to do is go out on a Saturday, tour a property, absolutely fall in love with it, and then call me or call your lender and find out that that is not within your budget. There's mellow roofs, or there's HOA we never talked about, or there's litigation in the complex, or it's not FHA approved and it's not going to be something that we can finance for you. Very, very important to select that right real estate agent. Now, we've got a lot of real estate agents that we work with. I have been in this business for many years, and I do work in many, many states across the country. So if you are looking for a home and you'd like a referral to a real estate agent, we would be absolutely happy to do that for you. We get nothing in return for giving you that real estate agent other than the satisfaction of knowing that we are giving you the referral to somebody that we have worked with, that we trust, that we have dealt with, and we know that they are going to have your very best interests at heart. Okay, so I did see that somebody asked, why not ask, what is mellow roofs? So that is actually a really great question. It is one of the words that was on my buzzwords at the beginning of the workshop. So you could go back and read the actual definition if you wanted to. But mellow roofs is it's a way of financing improvements that need to be made to the area where you are buying. So for example, if you are buying, and most of the time, this is where you see mellow roofs, if you are buying a new construction home and it is now an undeveloped area, they need to add schools, they need to add streets, they need to add streetlights, they need to do all kinds of things to this area. They are going to impose an additional tax that goes into the property taxes that is called mellow roofs. So on average, we'll see property taxes in Arizona that are about 0.7% of your sales price. California, 1.25% of your sales price. I have seen areas in California that were new construction that had mellow roofs that made their property taxes go from 1.25% up to 2.25%. That is a giant difference in your monthly payment, which is also a giant difference in how much that you qualify for, because you're qualifying based on the total monthly payment divided by your debt or divided by your income. So it can make a difference. And if that's not something that you're willing to pay for, you do need to make sure that you are asking that real estate agent to only show you properties where there is no Mello-Roos. Let's see. Laura says, gotta go. Thank you so much, Debbie. Great information. Laura, you are very welcome. Claudia says, great to know you work with many realtors that you can refer. Absolutely. We would love to get you handed off to somebody that we know, that we trust, that we've done numerous deals with. Let me tell you, it is one of the most important things that you can possibly do to be working with a team. If your lender and your realtor are working together to get you into the property, negotiate the closing costs, especially if you need a credit from the seller, make sure that the property is affordable for you, that you're looking at things that are within your budget. It works really, really well when you're working with a team. So definitely would love to give you guys all referrals off to great people, depending on where it is that you are looking and you are interested. And all you need to do is just reach out to the office, give us a call. We'll talk about where you're looking to buy, and we'll make sure that we hand you off to the right real estate agent. So we are almost there, guys. We're getting so close. The next part is going to be about, you found your dream home and you're writing a contract. So let's go. Okay, so you got pre-approved. You found the real estate agent you wanted to work with. You went out and you toured homes. You fell in love and you are ready to make an offer. So exactly how does that work? It is so important that you guys are writing that contract. You've heard me say it over and over again throughout all of these slides that you need to make sure that if you need closing costs covered, that you're writing that in the contract. You need to understand contingencies. That's a very important thing. But you are making an offer, right? So we're going to go to the next slide and we're going to see some of these bullet points to make sure we're getting you through these pieces of the puzzle. So the first thing that you need to understand in that contract is your earnest money deposit. So earnest money deposit means that you're telling the seller, I want your house. I mean it. We are going to open escrow, or we're going to open title, or I'm going to contact my attorney. We are going to put money down on this property. Now, the money that you put in is refundable to you if things don't happen the way that they should. So we're going to talk about those contingencies that you see here on this screen, but you do get to negotiate what your earnest money deposit is. Many times we'll see 3% written in a contract, just kind of as a standard number that real estate agents will use. But maybe you're a vet and you're getting into that home with zero down and you're asking the seller to pay closing costs, and you're literally going to get in to that property with no money down and no money out of pocket, no closing costs. So we'll call that one a VA no-no sometimes. So you might want to try to negotiate that I'm going to put $1,000 in as my earnest money deposit. It is a negotiation. That doesn't mean the seller's going to accept it, but it is a negotiation. So some people feel better with a flat 10,000 or a flat 5,000, or they really don't care about 3%. That's not a big deal because they're coming in with 10 or 15 or 20% down and they want to make the seller feel comfortable. So remember, all of these pieces are going to be a negotiating piece with the seller. So if you're coming into a multiple offer situation, there's a lot of people making an offer on the same property. You may want to give a bigger earnest money deposit to show the seller that you're serious. So you are going to negotiate that earnest money. You're going to negotiate your appraisal contingency. So this is a big one that we'll utilize a lot for our buyers to make their offer a little bit more appealing when there are multiple offers. So if you're trying to compete against other people that have also written an offer on the same home. So sometimes to get really competitive, you might not have any appraisal contingency, which means I'm going to buy this house regardless of what it appraises for. And this is the price I'm willing to pay. And if the appraisal comes in low, I will pay the difference. I will cash out of pocket, pay the difference, because I know that my bank will not lend to me more money than what the home is worth. Some people will shorten that appraisal contingency. So in many contracts, and it depends again, contracts are based on the state you're in, but in many contracts, a very standard time frame that we'll see is anywhere from 17 to 21 days, giving the buyer that time to get the appraisal ordered and get the appraiser out there and get the report back, so that if the appraisal does not come in at value, they can either choose to back out and get their earnest money back, or they can, then go to the seller and say, we need to renegotiate. Home isn't worth what we had, agreed to pay. So in order to get a little bit more competitive, maybe you don't feel comfortable just completely removing that appraisal contingency, which I would agree with, but maybe you can shorten that appraisal contingency. So if an average is somewhere between 17 and 21 days in your area, you might want to shorten that up to 7 days. And you're going to call me and say, Debbie, what's the fastest appraisal contingency that we can do? And 7 days is very doable. We can absolutely get an appraiser out there and get that appraisal back within 7 days. We've done them within 3 days and within 5 days. So you might have to pay a rush fee on that appraisal to that appraiser to make sure that they'll get out there and get that report back. But if you're trying to be competitive and you're trying to get a seller to consider your offer over somebody else's, that would be a place that you can do that in. So contingency would be appraisal contingency. You have loan contingencies. So again, a client might have a really low debt to income ratio. They've been completely pre-approved prior to going out there and looking, as they should have been. They've got, their money has already been verified for their down payment. There is literally nothing that they are concerned about that could come up or a hiccup with their loan. And so they may choose to completely just remove the loan contingency. They say, I'm putting my money in. I'm going to waive my loan contingency, which means if I do not get approved for the loan and I cannot close, you, the seller, you get to keep my money. I have no way to get my money back. But loan contingencies are set up for you as a buyer to make sure that your loan does come through and does get approved. So most contracts do have a loan contingency in the contract. So what that means is that you've got the time to say, I got my offer accepted. Debbie, please get started, get my file submitted to an underwriter and get my loan approved before I remove my contingency and the seller gets to keep my money. So again, most contracts will have somewhere between a 17 and a 21 day loan contingency is what we usually see on average, every state, again, being very different. But that is kind of the average. We'll see somewhere between 17 and 21 days. Well, to be very competitive, I've had clients call me and say, can I remove my loan contingency in 7 days? Absolutely. We will get that done for you. So remember that you don't necessarily have to remove a loan contingency to be competitive, but you could reassure that seller that you're going to remove your contingency within 7 days, which means that their home has only been pulled off the market by the buyer for 7 days, meaning that they have time to get the property back on the market if for some reason your loan did not come through. So make sure you're talking to your real estate agent about what you want to put in for that contingency as well. There's also a physical inspection contingency, and that is very important as well. Again, many times the physical inspection contingency will see 17 to 21 days. And this is all, most of these contracts are assuming a 30-day close. So the closing date is also very negotiable. The very fastest by federal law that a loan can be closed is 7 days from the date that the file is disclosed. So if you're trying to write in there, I'm going to close in 7 days, that is difficult. Have we done it? I have done it 2 times in my career, and that meant that every single party to the transaction was on board and knew this had to happen. And if I asked for a document, I got it, and I got it within seconds, from the buyer to the seller to the escrow company to the title company. Every single person has to be on their A game for that to work. And let me just tell you, that does not typically happen. 10 days does not typically happen. That is very unrealistic. Now, we've done a lot of deals in 14 days, start to finish, beginning to end, closed it in 14. I got appraisal back within 7, loan approved within 7, and we got to the closing table within 14. That is absolutely doable, and it can happen. So to do a physical inspection and a loan contingency and appraisal contingency all at these 17 and 21 days, you're not really keeping yourself very competitive if you're in a market where you've got multiple offers that are coming into this seller. So we want to keep you competitive. So you may want to also then reduce that physical inspection contingency. And what that is that's allowing you to get that physical inspector out there to make sure that the home, everything about it, your roof is good, your plumbing's good, just like I talked about in the buzzwords. Big difference between your appraisal and your physical physical contingency or your physical inspection. So you may want to shorten that up, and you'll talk to your real estate agent and say, you know, can we make this maybe 7 days? You might, before you guys decide how many days to put in that contract, you might want to start making phone calls to physical inspectors to see who's got time to get you on a calendar and what would be the soonest that they could do it and get the report back to you. But a lot of times we'll see this physical inspection shortened up from what would be average in a contract to maybe 7 to 10 days. So again, another negotiating piece and an important piece. And then termite. So some people will require that, you know, they're as a buyer, they're saying, I want you, seller, to provide me with a termite inspection. And sometimes you're going to say, seller, I want time for me to get a termite company out there to do the termite report. And you might be paying for it. So again, another negotiating piece and something to talk to your real estate agent about before writing your contract. So these are all things that are going to also happen throughout it. So you got your offer accepted. You're in escrow. So what happens? We've got to go through all these pieces of the transaction before we get to the keys at closing. You're going to get your contract gets accepted, and within 1 to 3 days, typically in that contract, you are wiring your money to your closing company. Again, whether that's title or escrow, an attorney, you're wiring your money in typically within 1 to 3 days. You're calling your lender and you're saying, I'm ready to go. And your lender's getting disclosures out and getting that appraisal ordered. We are getting all of the last pieces of the puzzle collected from you. So we might have gotten you pre-approved 2 or 3 weeks ago or a month ago or 2 months ago. And so now we're collecting updated bank statements and updated pay stubs from you very, very quickly, same day if you can move that fast, so that we can get that file submitted to an underwriter to get that loan contingency taken care of. You are ordering your physical inspection. You're talking to your real estate agent. You're finding that physical inspector and you're getting that ordered. And if you want to get a termite done and the seller's not the one responsible for the termite, you're making sure you're getting that termite ordered as well. So these are all really important things that happen once that contract is accepted, and you can see how important selecting that real estate agent is, because they are going to help you through, as well as your lender, and your realtor need to be a team. If they do not work as a team, none of this goes smoothly. So that is very, very important. Okay, so, and I kind of brought it up, you know, we've already sort of talked about this, so I'm not going to harp too much on it, but there were some important pieces of this slide that I didn't talk about in the last slide. So whoop, whoop, you are in escrow, or you've opened title, or you've, you know, contacted your attorney, you've got a signed contract for the seller. So the very first phone call is going to be to your lender, because of course we have all those contingencies we just talked about that we need to make happen for you. And your lender orders your appraisal, your lender gets your loan approved, your lender, right? So we're going to update documents immediately. We need to talk about locking in your interest rate, and locking in your interest rate is a very important piece of the puzzle. I actually just did one of my shows a couple weeks back was about locking in your interest rate. So I'm not going to spend more time tonight on that piece. You guys can go back and watch them. It's right here on YouTube in one of my folders. You know, you've got your playlists. Go back to my live playlist and it says locking your interest rate. So learn all about locking your interest rate. But that is something that needs to happen. You need to sign your disclosures. So as soon as you've got a contract and you contact me, I need a copy of that contract, and I need to get all of those numbers put together, and I need to order your disclosures. I cannot order your appraisal until your disclosures are signed, and I cannot submit your loan to underwriting until your disclosures are signed. This is a very important piece. Now, your disclosures are initial disclosures, so do keep that in mind. These are going to go out to you. You are going to sign them regardless of whether they're wrong or right. These are initial disclosures. This is not locking you into anything. This is not final documents. This is for you to review. You need to tell me if something's in there wrong. I've got your social security number accidentally turned backwards. The previous address where you lived is put in incorrectly. The spelling of something is wrong, street address, or your employer is incorrect. You're going to look at that, and maybe you forgot to tell me that you just changed jobs. So, you need to be looking at these things and telling me if there's something incorrect. These are going to be initial numbers for you to see. So this is the interest rate that we're anticipating that you're going to get. This is my best estimate to you that I believe you're going to need at closing. So this is my estimate of closing costs. Here's all of what I'm estimating to see. Again, remember, I have nothing yet. This is day one. I haven't contacted the closing agent to get an estimate from them for closing. I am doing my very best to show you what I believe from my experience of being in this industry for as long as I have been, what I'm expecting for you to see that you're going to owe at the closing table. You're going to see the estimated monthly payment. So you have not had time to find an insurance agent yet or find that fire insurance policy. So I'm giving you my estimate of what I see coming in on average for those homeowners insurance policies. So this is everything for starters. This is to get you started. So you're going to sign all of these documents, which is telling me that your intent to proceed. Yes, all of this looks good. We need to make a couple changes, but my intent is to proceed and move forward through the transaction. So now I can order your appraisal. Now I can submit a file to an underwriter, of course, after I've made corrections to anything that might be incorrect that you happen to see as you're reviewing your documents. So that is basically the most important thing. And I need to verify your escrow deposit. So one thing I do want to jump over to is where you see wire deposit to escrow or wire deposit to your closing agent, your title company, or your attorney. Again, all very important things that have to happen right there at the beginning. But cash is not okay. You cannot drop off cash to the closing agent. You can bring in a cashier's check if you want to, but it is more difficult for us to source, and every single deposit in your bank account we have to source. Every single deposit going into the closing agent, we have to source where it came from. Wire is the very best way to go, and it really is what you should be doing. So your closing agent will be providing you with wire instructions. So be prepared to either get online through your online banking and set up that wire, or walk into your bank branch to request that wire. But please do it by wire. That is really the very best way. No personal checks, no cash. We just don't want to go that direction. A cashier's check can be used, but we don't prefer it. And many times they will get put on hold. And then, of course, order your home inspection like I talked about in the previous slide. So we're in escrow. We're moving. We're going fast. We are rocking and rolling, and there is a lot to do. And this is when we get really, really busy. So as much work as we can do prior to, the better, because this is where the stress level starts, and this is where it gets really crazy. So we want to make sure we have done a complete pre-approval with you before we get you out on the street. I might ask you for a whole bunch more information that maybe a different loan officer that you've talked to before in the past has asked you for. And that is because I know when that loan goes into underwriting, you are going to come out with a bunch of conditions. And I don't want you, while you are stressing out about meeting a physical inspector, negotiating with a seller for repairs that you want done, just everything that is going on within this transaction. I don't want you then also stressing over a list of 30 items that my underwriter wants from you after loan approval. You need to remove that loan contingency. I want that loan approval to come in and come out clean, with maybe a couple of conditions that are very, very easy for us to obtain. And I've got loan approval. Those 4 items, super easy. I'll get those to you. Hey, realtor, I can remove my loan contingency now. So I am going to do my due diligence, and I'm going to ask you for everything up front. It's going to feel like a lot for a pre-approval, but it is so that this part of the transaction is a little bit less stressful, and we bring that craziness down a bit. So be prepared to provide a lot of items. Okay, so I can see that there was a comment that came in that said lost audio, can't hear. We did actually try to look at it from our phones on YouTube, and we could hear. We didn't, like on our end, we could still hear the audio. I'm so sorry if you had any issues at all. Anybody else that is still watching, jump in and let me know if for some reason you can't hear either. But we were able to hear it when we looked at it from our phones. So I I do think that our audio is still okay. I haven't seen any other questions come in, and we are only 2 slides away from being done. So you've already made it this far. Hang in there. Don't go anywhere yet. We are going to move right now into closing your loan. So there's a couple of key things that are very important for you to know as you get close to getting, to the closing table. So here we go. We're going to get this one done. And then the last slide is literally just going to be more of your questions and how do you contact us if you don't already know how. So here we go, closing your loan. Okay, so you made it through. Appraisal came in great. We removed our contingency on our loan. We got approved. Just everything has worked out perfectly. You did your physical inspection, nothing crazy with the house. There weren't any termites, or if there were, the seller was totally willing to do the repair work for you, or you had no problem jumping in and saying, hey, we're willing to do the repair work. Whatever it was happened, we are there. We're ready. We're ready to close. So what happens at this point in time? So as I mentioned previously, those initial disclosures were to get us started. Now we're at a point where we are going to provide you with your closing disclosure. Sometimes people are going to call that a CD. We want to show you these are the final terms. This is where we're at. We've gone start to finish, approved the loan. Everything has got, happened. We've made it work. This is where we are. Here's your final terms. And so on this closing disclosure, you're going to see your sales price. You're going to see your down payment. You're going to see your interest rate, your total monthly payment. You've shopped for your homeowner's insurance. You've provided me with a copy of the quote. I've ordered a binding policy for you. So now your insurance are accurate. The title company's provided me with the information about property taxes. So now your property taxes are correct. I have all of the title company's fees, all of the escrow company's fees, all of the attorney's fees. Everything is accurate. Here it is. Do you agree with these numbers? And so this is your most important piece of the puzzle. This is what allows us to get you to closing. So I have to give you this disclosure. You need to review it. Everything has to be what you're expecting and anticipating. And if something is different or something's unexpected, do not sign it. You call, you stop, you call your loan officer and you say, I don't understand. This is not what we talked about. I have to bring in $3,000 more than what you showed me at the beginning. If you have a good loan officer, that is not going to happen. It just isn't going to happen. They're either something came up with your loan that they're communicating with you along the way. They're telling you that something took place. Appraisal didn't come in at value. Something happened that you and your loan officer should be thick as thieves throughout a transaction, and you should know that something changed. So this closing disclosure should not be a giant surprise, but you absolutely do not sign it if there is something that doesn't make sense or the numbers aren't what you expected or the monthly payment is significantly more than what you were told that it was going to be. So this is a very important piece. Now, it's also very important because from the time that you sign this document saying, yes, I agree, these terms look awesome, I'm good, we cannot issue you your loan documents to sign for 3 business days. So that puts you off. If you've got a closing date that is March 31st and your loan officer has not sent you a closing disclosure by like March 25th or March 24th, you're not going to be closing your loan on time. You're not going to make it to your closing date. So it is very, very important that if you haven't seen your closing disclosure or CD in your inbox to be signed electronically, a minimum of 3 business days. So that's business days prior to what date you're supposed to be closing on your home. You'd better pick up the phone and start calling and finding out if there's some sort of an issue that you're unaware of. So I try to get my closing disclosures out about 10 days prior to our closing date, which is why you can see that we have a 7-day. There is no possibility. It's not even allowed by federal guidelines that we can close with before 7 total days because I have to disclose your loan and you have to sign your disclosures at the beginning. Then I have to give you a closing disclosure that you have to sign 3 days before closing. And we're talking all business days. It's not even possible to do it before 7. So I try to get my closing disclosures out about 10 days prior to our closing date so that everybody's got time to review, understand, talk to me about it, sign it. Now we've got time to get our closing documents to the closing agent. So again, whether you are in an escrow state, a title state, attorney state, we need to get those closing documents out so that they can be reviewed. They can set up and schedule a date for you to go in and sign these final closing documents. Gives you time to be able to get your money put together, to wire in the additional funds that are required for closing. So this is a very important piece of the puzzle. Do not just sign it because it comes in and you just want to move things along. Review it. Make sure you agree with it so you don't end up at the signing table with numbers that you don't agree with. You want to make sure you catch that prior to those loan documents going out. But we're there. When you get this one, your loan's been approved, your appraisal's in, it's been reviewed. You're there. You're at that point that we're getting ready to close. So very, very exciting times for you. Okay, so we are moving along, man. We're doing so good right now. We're almost there, I promise. And I did, like I said earlier when we first got started, I did all of these slides in advance on purpose so that we could stick to the timeline and try to get it done. The last workshop that I did ended up running about 3.5 hours because I was going through the PowerPoint and questions were coming in as I was going through it. And so this has seemed to work out really well. I'm very happy about it. I know it's long, but I am taking you from start to finish through the process. So I hope you guys feel like you're getting a lot of really valuable information. We did have a question come in that says, and this is from Why Not, what is the time frame on getting all of that in? So I believe that came in when we were talking about the getting your money in, getting the appraisal ordered. That all needs to happen super fast. If you were referring to getting paperwork in, like for your pre-approval, just throw that in the feed and I'll answer that in a different way. But when you get your offer accepted and everything is moving forward, depending on the state that you're in, whether you're the escrow state or you're a title state or an attorney, everything starts to move really fast. You need to get all those updated pay stubs over to us. If, it's been a minute since we did the pre-approval, we need to get that appraisal ordered. We need to get those disclosures signed to get that appraisal ordered. We need to get, the disclosure signed to get the file submitted to an underwriter. If you're shortening contingencies and we've only got 7 days to get it all done, we need to move and we need to move very fast. You want to get everything you can possibly get done as fast as you can get it done at the beginning of a transaction so that it's all done and it's out of the way. And now you're just literally window shopping, not spending money, but window shopping for that new furniture that you might want to have for that house, or, while we're just killing time waiting for appraisals to come in, you're getting homeowners insurance estimates and things like that. So if I didn't answer that question right, please just be more specific. And then I did get another question that says, can you make referrals for home inspectors in California? So honestly, no. I am not part of that piece of the transaction. So do I know some home inspectors? I do. But I'm not part of that piece. So I am responsible for ordering your appraisal. Your real estate agent is responsible for making sure that you get your home inspection done within your contingency time frame. And they're the ones that are meeting you at the home. They're meeting with the inspector with you. And so your real estate agent is honestly your very best person to ask about referrals to home inspection companies. And you can also just Google it, and you can find your own completely independent person to do it. If you have a family member who's a contractor, somebody that's a contractor with a license could probably do a pretty darn good job at that physical inspection. But since I'm not out there meeting inspectors, I honestly don't have like a running list of people to be able to send referrals to. All right, so we are just about there. We're going to go to the next slide. It is just how you contact me and my office. I don't see any other questions coming in, but I will come back after this slide. I do finish the slide like bye, see you later. But I will come back one more time just in case there are additional questions that come in that you haven't asked yet or you forgot to ask. So we're going to do this last slide, just how do you contact us. I hope everybody that was on this workshop today is ready to get pre-approved, and we'd love to work with you. So get yourself your appointment. But here we go. I'll be right back. Okay, so very last slide, guys, and I know you guys know how to get a hold of me, but obviously I'm doing this workshop. All of it is free education to you. I love this. I love doing what I do. My goal behind my marketing is not to throw out interest rates and claim to be the best or to be the lowest and hope that you pick up the phone and you make my phone ring. My goal is to educate you, work with you, bond with you, and hope that because of that, you feel a comfort level in me and in my team, and that you want to work with me. So I do just want to pitch that really quick. Guys, we need you. We don't make money without you. We want to help you. We want you to be our clients for life, and we want you to call us. So here's a direct phone number to my office, my toll-free number. Obviously, I have my website, mortgagemomradio.com. You guys should all have my tools app at this point from the beginning of the website. You can listen to the podcast. You can follow on YouTube. You can see me on Facebook. You can see me on Instagram. I'm on TikTok. We are here to educate, to help, and we do hope, pray, and wish that you guys feel that you have found the right lending team for you and that you are going to reach out and you are going to work with us for your financing needs. So with that, I hope you guys all enjoyed this workshop today. Again, remember, happy to do one-on-one consults with any of you. Go to that website, click on that appointment button, schedule an appointment for a consultation, and let me and my team get you guys started and headed in the right direction. Okay, guys, so that's it. That is the end of the workshop. I don't see any more questions coming in, but once again, please feel free to reach out. You can email us, you can text us, you can call us, whatever is the easiest way for you to get in touch with us for you is totally fine by us. We want to answer those questions. And if there was anything that we missed, please ask. And I can see why not. Says, this has been splendid, so informative. Thank you. And you are very welcome. Stephanie said, thank you for all the information. Heather said, thank you. Great info. So you guys, I'm reading all the comments and I sure do appreciate it. I really hope you enjoyed it. And I hope that I see you guys as buyers and in my pipeline and working on your loans. I want to see you guys be homeowners and start building some equity. So I hope you guys have a great one. I'll be live again on Wednesday right here on YouTube. So if you are not subscribed to my live, make sure that you guys subscribe if you want to see the show once a week. So all you're going to do is the same phone number that you texted RSVP, you're going to text live. So text live, LIVE, to 844-935-3634. That's 844 We Lend For You. WELEND and the number 4. Hope you guys have a fantastic night. I'll talk to y'all real soon. Bye-bye.
Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done. When you're in need and don't know where to go, pick up